What is up, everyone, and welcome back to Explain the Charts. Today is October 12th, 2025, and we are looking at a very eventful chart for Ethereum after a turbulent week in the crypto markets. First, let's cover the news because it is impossible to understand the recent price action without the macro context. Multiple sources have described the market action on Friday, October 10th, as a record-breaking bloodbath and crypto carnage. This was reportedly triggered by escalating US-China trade tensions, with threats of new tariffs creating widespread fear in both crypto and traditional markets. This fear-driven event led to a massive liquidation cascade, wiping out over $600 million in leveraged trading positions across the market. Ethereum was hit particularly hard, accounting for over $235 million of those liquidations in long positions alone. We saw reports of ETH plunging 7%, though as we'll see on the chart, the daily move was even more severe. This sell-off occurred after ETH repeatedly failed to break through a key resistance level around $4,800, which many analysts were watching. This failure likely prompted initial short-term profit-taking, which was then massively amplified by the cascade of forced liquidations. However, the news isn't entirely bearish for the long term. We're seeing continued institutional interest, with Morgan Stanley expanding crypto access to all its clients starting October 15th. Additionally, Grayscale just introduced staking rewards for its Ethereum Trust ETFs, creating a dividend-like return that could boost institutional demand. Whale wallets, such as Bitmine, have also been reported to be accumulating ETH, increasing their holdings significantly despite the volatility. So we have a classic conflict, a terrifying short-term picture driven by macro fears and leverage, against a backdrop of strengthening long-term institutional adoption. Now, let's pull up the charts and see how this all played out in the price. Here on the daily chart, we can see the broader story of the last few months. After a significant drop in August, ETH staged a powerful recovery, climbing all the way from below $2,000 back toward its highs. Let's zoom in on the action since mid-September to get a clearer view of the recent events. As you can see, the price pushed up strongly through late September and early October, building significant momentum. This climb culminated in an attempt to break past the $4,700 to $4,800 resistance zone, which the news reports highlighted as a major hurdle. The price stalled here for several days, showing weakness and an inability to push higher, which is a classic sign of seller exhaustion. And then, we see this catastrophic red candle on October 10th. This is the liquidation cascade we were just talking about, represented in a single day's price action. The price opened at over $4,300 and plummeted to a low of $3,500, an absolutely massive drop of over 11% for the day. The volume on this candle is significant, though not the highest we've seen this year, indicating a rapid flush of leverage rather than a sustained, broad-based sell-off. The following day, October 11th, we saw a bounce and a close back up at $3,750, showing some buyers stepped in at those lower prices. This suggests that the $3,500 level has now been established as a critical short-term support. To truly appreciate the ferocity of that drop, let's switch to the 1-hour chart and isolate October 10th. Here you can see the day started relatively calm, trading in a range. But around 1400 hours Universal Time Coordinated, as mentioned in one of the CoinDesk reports, the selling pressure materialized with immense volume. The price fell off a cliff, dropping hundreds of dollars per hour with very little relief. This is what a liquidation cascade looks like on a lower time frame. Each stop loss and liquidation triggers the next one down in a chain reaction. The price eventually bottomed out at that $3,500 mark before finding any meaningful support. Now, coming back to the full daily chart, let's map out our key levels for the bigger picture. The most important resistance level remains that $4,700 to $4,800 zone, where the recent rally failed. Until that is decisively broken, the long-term trend remains in question. The next major resistance area to watch is the zone between $4,100 and $4,300. This area acted as support during the consolidation before the crash, and as per classic technical analysis principles, it will now likely act as strong resistance on any move back up. On the support side, the immediate and most critical level is the October 10th low of $3,500. A daily close below this level would be extremely bearish and would signal a continuation of the downtrend. Below that, we would be looking at support levels from back in July and August, potentially around the $3,000 to $3,200 range. So the current trading range is quite wide, defined by this recent volatility. Let's switch back to the 1-hour chart and look at the last 48 hours to understand the current battle. After the bounce from $3,500, the price rallied strongly back to the $3,900 area before pulling back. Currently, we are consolidating in a range roughly between $3,700 and $3,900. This is a period of indecision where the market is trying to figure out its next move after the big flush-out. Bulls will want to see this consolidation hold and for the price to make a new high above the recent $3,933 peak from October 11th. If they can achieve that, it would show strength and a potential move to retest that $4,100 resistance level we identified earlier. Bears, on the other hand, will be looking for this bounce to fail. They want to see the price break down below the $3,700 support and head back down for a retest of the $3,500 lows. A failure to hold $3,500 on a second test would be a very weak sign. Finally, let's drill down to the 15-minute chart for the most immediate price action. Over the last several hours, we can see the price is coiling in an even tighter range, with volume tapering off. This often happens before a significant move, as buyers and sellers reach a temporary equilibrium. We are essentially building energy for the next leg up or down. Traders should watch for a high-volume breakout from this tight consolidation range, which is roughly between $3,720 and $3,760 right now, as a clue for the next short-term directional move. So, to recap everything on the daily chart, here is what we are looking at. Our major overhead resistance is $4,100 to $4,300, and above that, the previous high is around $4,800. Our critical line in the sand support is the recent low at $3,500. The current price is caught in the middle of this large range, battling around the $3,750 mark. So, what are the probabilities? Given the severity of the recent drop and the macro uncertainty, a retest of the lows is a very real possibility. I would place a 55% chance that we see prices test the $3,500 to $3,600 area again in the coming days. This likelihood increases if we see the price fail to break above $3,900 on the hourly chart. On the bullish side, the long-term fundamental news is strong, and the market has been reset from over-leveraged positions. I would assign a 45% chance that the low is in, and that this consolidation will lead to a breakout upwards towards the $4,100 resistance. This scenario becomes more likely if we see a decisive, high-volume move above $3,900 and a daily close above $4,000. Things to watch for our institutional flow data, any further news on trade tariffs, and the daily close relative to the key levels we've discussed. And finally, please remember that this is just my analysis and perspective. This content is for informational purposes only and is not financial advice. You should always do your own research and make investment decisions based on your own risk tolerance. Thanks for watching Explain the Charts, and we'll see you next time.